This is a podcast from the Business Times.
The S&P 500 notched a record high close yesterday, fueled by advances in heavyweight technology stocks. As tame producer price inflation data supported expectations, the Fed will not raise interest rates at its September meeting. In Asia, the yen headed for its biggest weekly loss in 3 months today as the impact of US and Japanese intervention faded, leaving traders to wager another round of official buying would be needed to stem the rot. And Asian stocks climbed as further evidence of that moderating US inflation came to light. I'm Howie Lim. Welcome back to Market Focus Weekly. It's Friday, August 14th, 2026. And joining us to dissect is Arun Sai, Senior Multi-Asset Strategist at Pictet Asset Management. Arun, thanks for your time.
Thank you for having me.
I want to start with inflation versus reality, though, following the recent tame July CPI data. Why do money markets seem so quick to slash Federal Reserve rate hike expectations? There a risk that investors are being overly optimistic, ignoring the potential for a late-year resurgence in inflationary pressure?
So you're right, it was a tame print, and sometimes boring is good. We were precariously balanced in that the markets were getting a little anxious about the Fed signaling in terms of withdrawing forward guidance. And while we think that's fundamentally good for the overall ecosystem, that we focus more on the real economy, focus more on what companies are telling us, rather than being obsessed about each central bank governor's speech at every university and conference. The problem, though, is when you remove an important part of the bond investors' toolkit, cold turkey. I think bond managers do require a certain uncertainty premium, which is why the long end of the US bond market was beginning to kind of sell off.
Yeah.
What we got, though, was a sigh of relief in terms of data. Data was definitely on the softer side, both in terms of the labor print earlier in the week and the CPI print, which, as you say, was quite benign. It was
quite tame, yep.
The big picture is that it's not just one print. It's not a one-off. If you look at the series of inflation prints we have had, there is no real evidence of second-round effects from higher oil prices. And by and large, we think inflation dynamics are quite benign. We're not going to get back to a 2% target anytime soon, but a gradual grind lower in inflation. There is going to be volatility from time to time, but I don't think there is enough evidence to warrant a significant hawkish shift from the Fed.
Let's talk about the Bank of Japan's credibility then. There's speculation mounting that the BOJ could hike interest rates as early as next month ahead of previous December expectations. Is this a credible long-term policy shift, or is it primarily a reactive measure to contain the yen's ongoing volatility?
Yeah, no, so I don't think we've seen enough for this to be a significant shift in the medium term. What we've seen from the historic coordinated intervention between the Ministry of Finance and the US is very important in terms of what it means for signaling. But as we know with the history of such interventions, these are usually useful in breaking up the momentum in one-directional bets, but they don't in and of itself usually lead to a sustained turning point.
Okay.
For that, we need to see one of two things. Either the Bank of Japan turn more hawkish, and as you say, there are recent reports that they've received a green light from the Takaichi administration to do that, or at least signal the prospect of more frequent rate hikes.
Yep.
But equally, we don't see the Bank of Japan acting very forcefully. And the second point is, if you look at the size of these interventions, they're quite small compared to the scale of capital flows. It's almost a drop in the ocean. So what you really need to see for the yen to turn around on a structural basis is confidence. Confidence in the yen would have to come from capital flows. That's both foreign capital flows coming into Japan and domestic investors wanting to repatriate their foreign investments back into the domestic economy. And we don't quite see the catalyst for this to happen. If you think of the incentives of domestic investor, they're still seeing the S&P 500 at all-time highs. US earnings is extremely extremely large. So we don't really see the catalyst for that. And the one signaling catalyst could be what the government pension fund signals through their asset allocation. That would be useful if we see traction in that direction. But equally, we don't think this is going to be a sustained turning point. So we see a collection of all these events as maybe drawing a line under the depreciation of the yen rather than a sustained turnaround.
Speaking of turning points, there was some talk about AI's capex narrative coming under fire. Foxconn's 35% profit jump this week, though, underscores that the dominance of AI infrastructure demand is kind of still there. Given recent broader skepticism regarding AI valuation, though, are we maybe witnessing a bifurcation? Where hardware enablers like Foxconn remain secure while broader tech sentiment faces a correction, be it necessary or not?
Yeah. First, the big picture is that we are constructive on the AI cycle. We think we are still early innings. We think there's still a long runway. All of that is well and good. But what you're going to have, even within that kind of a structural capex build-out cycle, is you're going to have cycles around it. You're going to have periods where...
Cycles within the cycles.
Absolutely.
Okay.
Cycles within the upswing, right? So we are in the first genuine super cycle, essentially, following the commodity super cycle of the early 2000s. Within that, we are going to see new developments, which is going to lead to a period of indigestion within the AI capex ecosystem. And that's what we've had so far this year. We've had a lot of momentum, trades being unwound. And thankfully, you are seeing, as you say, a rotation within the AI ecosystem back from the capex beneficiaries like semis and memory into the capex spenders like hyperscalers. So that kind of rotation is healthy in a way because it makes the cycle more balanced and more sustainable rather than one part of the ecosystem continuing to pull away, which would be stretched. But the important point to keep in mind here is we think, going into the third phase of the AI trade. The first phase being a rising tide lifts all AI boats. So you just had to be vaguely associated with NVIDIA for your stock price to go up. You needed AI in your ticker and boom, prices went up 25%. We're not in that phase. Then we moved into the phase which you describe as enablers versus spenders. And the focus at that point was finding the next choke point. Memory was supposed to be the choke point, and we've seen a significant surge in profitability when agentic AI deployment was much stronger than expected. That, we think, is now behind us. We are entering this third phase where increasingly it's going to be stock level dispersion. And within hyperscalers, for instance, they're going to have to tread a very fine balance. On one hand, you have to make sure that capex is in line with what the market is comfortable with, because these hyperscalers are now reliant on the market to fund their future capex. It's no longer redirecting their own cash flow. You need to continue providing proof of monetization to keep the market satisfied when they demand to see the return of all of these investments. And we don't think all companies can manage to pull that off equally well. So by definition, we think the next phase is going to be about single stock dispersion.
All right, still to come, let's stay in Asia and maybe tackle oil and war as well. More with Arun from Pictet in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. Arun, Southeast Asia is showing incredible economic resilience. Thailand's second quarter GDP growth was slowing sharply, though, as subdued household consumption offsets gains in export. Does this signal a broader structural cooling for Southeast Asian economies as the regional recovery runs out of steam, maybe?
Yeah, so I wouldn't read Thailand as a canary in the coal mine for Southeast Asia.
Despite it being second largest, I think,
Yes,
economy.
because if you look at the soft consumption which is coming through, that is a regional theme. But what sets Thailand apart is some structural factors. It has a low growth ceiling from having high household debt and from demographics, whereas economies like Vietnam and Malaysia are more geared towards capturing the tech and the FDI investment cycle more forcefully. But the more interesting point, I think, is that this is a microcosm of what's happening in the global economy, because what you're seeing increasingly is yet another representation of the K-shaped cycle. We are seeing growth hold up at an aggregate level, but there's significant dispersion underneath the hood. We are seeing that across countries, across sectors. Technology and capex intensive areas are still very strong, whereas the rate sensitives and the consumer oriented economies are facing the heat. So for us, this is evidence that you cannot look at isolated cases and expect the whole aggregate to roll over. So we are still by and large quite constructive, the global economy and most regional economies as well, including ASEAN.
Would you say then it looks like Asian markets are becoming desensitized maybe to geopolitical shocks and such, because Asian markets largely shrugged off that North Korean missile launch this week, and maybe the markets anyway, too laser focused on the Fed to care about what's happening in their own region?
Yeah, I think markets do have a habit of, from time to time, overestimating the impact of geopolitical events in the short term, but underestimating its lasting impact in the medium to long term, right? So we have to keep in mind that most geopolitical risk events are buying opportunities, because we see, with the benefit of hindsight, of course, the vast majority of them don't permanently alter the cycle.
Okay.
Right? So yes, to your point, there is perhaps a little bit of a news flow fatigue in topics which are already familiar. But the key question to ask is, in and of itself, does this have the ability to fundamentally change the cycle we are in? And we don't think that's the case. So we think investors are largely right in trying to look through the chaos, look through the daily news flow. But it perhaps reinforces some of the medium-term to long-term mega trends which we have in mind, that increasingly this is going to be an era when geopolitical fragmentation is a part of the backdrop, significant pickup in defense spending globally, duplication of supply chains in tech and beyond. So it goes to kind of reinforce some of these medium to long-term themes rather than something which markets have to react on a daily basis.
Help us figure out South Korea's volatility then. Their equities demonstrated remarkable headline-grabbing strength this week, leading regional rallies. Should maybe investors view this as a sustainable recovery, driven by solid tech fundamentals, or is this simply a volatile reaction to shifting macro signals? They did also just snap that 7-week losing streak.
Right. So I was in Seoul a couple of days ago talking to investors there. I got a sense that there is no high-level conviction in terms of when we'll draw a line under the volatility. And that is not great for the investment case overall, because what we're saying is we don't think there's a fundamental shift in the investment case for memory or the cycle overall. We still remain quite constructive. But for foreign investors, especially, to consider Korea as a sustainable source of returns, they have to be able to stomach the volatility without blowing out their risk budgets. So it becomes quite challenging, and especially with the kind of concentration risk which you're taking on with the position in the cost. We think that the market has to do two things. One, it has to give foreign investors and domestic investors the confidence that there are guardrails in place to make sure that the market structure becomes less vulnerable to the kind of volatility, to the kind of retail leveraged ETF-driven spikes we've seen. And also over the medium term, what we would really like to see in Korea is some kind of a framework to make sure that the windfall gains that the economy is having right now is extremely concentrated in a couple of stocks, essentially. So we would like to see a framework in how these windfall gains are going to be distributed more widely so that it can be a more sustainable development story. Till we see some traction on that front, we don't think your average foreign investor is in a hurry to kind of file back into Korea just yet.
Speaking of volatility and risk premiums, that is, do you think the war premium on oil, energy stocks maybe is becoming a permanent thing? Necessary even, perhaps, because of all of this instability, right?
Absolutely. And we think to be constructive equities, you don't need to see a permanent end of the conflict, because equities have the ability to ruthlessly discount a period of uncertainty if they're convinced that the direction of travel is towards normalization. And the big picture view we are taking without kind of getting whipsawed by the news flow we are getting on a deal or no deal and all the contradictory statements we are seeing from either side, is that we think ultimately the direction of travel is towards some sort of normalization. We don't know what shape or form that will take. We don't know the exact timing.
What is that based on? Data or gut?
So that's based on a view that it's in neither side's interest to see
to prolong it, right?
Re-escalation. In the case of the US, of course, you're getting closer to the election. Iran is probably playing for time to make sure that they maximize their leverage. And the further this goes closer to the election, that's probably when they could extract the best deal possible. On the other hand, we don't agree with those who think that Iran holds all the cards and there is no threat against them. Ultimately, they care about their economy as well for the regime to stay in power. And there is always the ultimate threat of punitive strikes, punitive action. So no one wants to go there. What we are seeing is a case of brinkmanship. Ultimately, we will get a resolution. Oil, on the other hand, is a spot asset. Oil doesn't have the luxury of discounting out. If you want a barrel of oil today, you need to buy a barrel of oil today at the clearing price. So that is why we are seeing volatility in the oil price, and we expect that volatility to continue. But in and of itself, we don't think this is capable of derailing the global cycle. For that, we would need to see oil prices well north of, say, about $120 for about 6 months. That's when we think demand destruction kicks in.
Sounds good. Well, relatively. Arun, thank you for your time and your insights today.
Thank you.
Lots to keep an eye on. Arun Sai, Senior Multi-Asset Strategist at Pictet Asset Management. If you have questions or feedback, you can drop us a note, btpodcasts@sph.com.sg. And for the latest, tune into Lens On Daily, 10 a.m. on Monday morning. This has been Market Focus Weekly. Till next week, I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.